Welcome to lesson number 7, and here we will discuss material in chapter 9. In lesson 7, we examine performance measurement in decentralized organizations. We begin with the advantages and disadvantages of being decentralized. Next, we look at the return on investment analysis of performance. The concept of residual income is introduced after this. Several operating performance measures are added, including delivery cycle time, throughput time, and manufacturing cycle efficiency. We conclude with the balanced scorecard concept. As you may have guessed, each of these ideas are relatively recent additions to the toolkit of the management accountant. They are most likely to be found in the more progressive firms with the more enlightened leadership. When an organization is decentralized, it means that decision-making authority is spread throughout the organization rather than being confined to a few top executives. The larger and more complex the business, the more decision-making needs to be delegated. The advantages are manifold. Customer response time should improve. Motivation and job satisfaction are enhanced. Lower-level managers are better prepared for advancement. Top-level managers have more time for strategic planning. And of course, there are disadvantages. Decision-making can lack coordination. Objectives of a division may clash with those of the entire organization. Lower-level managers may lack perspective. One useful means of controlling the negative aspects of decentralized decision-making is termed responsibility accounting. Each manager is made responsible for those factors that he or she controls. These include revenues, costs, profits, and investments. Managers are graded for performance only on those aspects of the job that apply to their job. Some may be evaluated on more than one of these 4 items, depending on their level of responsibility. Investment managers are evaluated using an measurement called ROI, return on investment, or some other residual income measure. ROI is defined as net operating income divided by average operating assets. Net operating income is income before interest and taxes, and is also referred to as EBIT, or earnings before interest and taxes. Operating assets include short-term and long-term assets held for operating purposes. Because long-term assets are depreciated over time, the denominator of the ROI decreases, which increases overall ROI automatically. One way to eliminate this bias is to consider only gross asset costs and ignore depreciation when calculating return on investment. The more common practice is called asset valuation, which measures purchase price minus accumulated depreciation. And as we indicated, this does give a slightly biased result over time. Alternative definitions of ROI will increase your understanding. ROI is equal to margin times turnover. Margin is equal to net operating income divided by sales. And turnover is equal to sales divided by average operating assets. When we combine these terms into a single formula, we get what's called the DuPont formula, which was pioneered by E.I. DuPont Nemours and Company. Exhibit 9/1 shows how this system operates throughout an organization. Of course, there are several valid criticisms of the use of return on investment to evaluate managerial performance, and these are listed in just after Exhibit 9.1. Another approach is to use residual income to measure performance. This is defined as the income above the minimum required return on assets. Economic value added, or EVA, is one example of a refinement of the simple ROI principle. The text does not go into the distinctions at this time, mercifully, but in more advanced courses we'll take a close look at this. Operating performance measures are introduced next. These include delivery cycle time, throughput time, and manufacturing cost efficiency. Each is defined and discussed briefly. Each has its own extensive literature as well. Finally, the balanced scorecard is introduced and discussed. Under this system, management translates its strategy into performance measures that employees can understand and influence. Some of these can be qualitative rather than quantitative measures. Why do companies fail to execute their strategies? First of all, only 5% of a company's workforce understands their organization's strategy, and that's being generous. Second, 85% of management teams spend less than 1 hour a week discussing strategy. Third, 60% of companies do not link budgets and strategies. And finally, only 25% of managers have their incentives linked to their strategic metrics. This footnote is credited to Robert Palladino on page 414, and it gives you an idea what management is up against in trying to run a large, complex company with centralized or decentralized management. And next week we'll take up the last of the topics for our class. Make sure that you're caught up on all of the discussion questions so that I can get those graded. Thank you very much.